Hi, and welcome to our end of the year update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with the current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. All of the strategies in this book are easy to calculate each month. For those of you who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this is a year-end review, and in my quest to keep improving things, to better teach without jargon, I've totally revamped the names of our systems so that they're a little bit more understandable. So for instance, since we usually review both the 20-month moving average system as well as the sector server storm guard system, since they're both basically the same things, just with different degrees of sophistication in the algorithms, I'm just lumping them together into safety belt systems, trying to tell whether or not it's relatively safe or dangerous to be in markets at any one time. And then we'll review the momentum rotation systems, and I'll explain why I've changed this name as well. We'll monitor the free sector server strategy that usually comes with your subscription, and remind us of the rules for the stock tip strategy. Again, when I use numbers like the 25% trailing stop loss system, people kind of get tangled up in the weeds of the numbers. So I'll just use the stock tip strategy. So let's begin reviewing our systems. And to make this video a little bit easier to follow, and make sure you don't confuse these systems, I'll list the system on the top of each section. And the first system we'll follow is the stock market safety belt system. Think of the 20-month simple moving average system. This is a safety belt for stock market investing. You check once a month and see whether or not it's relatively safe or dangerous to be in the stock market for that month. Remember, it's a safety belt. It does not guarantee against all losses. All it does is increase our chances for survival during a market crash. If we can just mitigate the market crashes and let the winners take care of themselves, that's already significant. So the 20-month moving average rule, basically, originally we just took the S&P 500 Index mutual fund with its 20-month moving average. In other words, this is a filter averaging the price of the mutual fund for the last 20 months. If the price of the fund is above the moving average, it's relatively safe to be invested in the fund, otherwise get out. Remember, this moving average is our safety belt. It only works if we watch it every month. So here's our 20-month moving average system in action. So we look at this month, the VFINX, which is the S&P 500 Index mutual fund put out by Vanguard, closed at a price of 231.44. The moving average closed at 241.17. It's a crossover. You notice that this number is now below the red line, and according to this model, the stock market is now dangerous enough that we need to get out. So that's a trade alert. So here's what the model shows was supposed to happen if we happen to have this model way back since 1986. Every time the blue line crossed below the red line, we got out of stocks and we went into long-term treasury bond fund. And when the blue line went above the red line again, we went back into the stock fund. Bond fund, stock fund. Sometimes we get whipsawed, and we'll see how long we'll stay in the bear market this time. Yes, there's always a chance that next month the stock markets can go back up, but more than likely, if it's the beginning of a multi-month to multi-year bear market, we're catching it earlier enough to make a difference. So let's think about this. Why are we using the S&P 500 Index fund? Well, the S&P 500 Index is a very widely followed stock market benchmark. Many investors judge how they do compared to the index. So for instance, if one year they make 5%, is that a good return or bad return? Well, you have to think compared to what? Well, if the index went up 10%, then you're lagging. But if the index lost money, then you're doing great. Not only that, there are so many S&P 500 Index mutual funds out there. Pretty much every major mutual fund company has some kind of variation on this index fund. So no matter which 401k plan you have that limits the number of choices of funds you can have, chances are you probably have access to their version of the S&P 500 Index mutual fund. Now remember, index funds tend to beat more actively managed funds. It's not always the case. It beats roughly 70% of the actively managed funds in any one year. That means 30% beats the index. But year after year, it's hard to beat the index fund. And index funds tend to have lower fees. We're just using the index fund itself for our investment strategy and using the index fund itself to calculate whether or not it's relatively safe or dangerous to be in the stock market and to begin with. But what if we compare the S&P 500 index to the total U.S. stock market index? That means instead of just taking the 500 largest stocks in the U.S., what if we took every single stock in the U.S. and measured that index compared to S&P 500 index? Well, if you were to lay those graphs over on top of each other, they're pretty close together. So if you don't have the S&P 500 index, you can go ahead and use a total stock market index if that's what you have available to you. Now, there will be slight fluctuations in your actual returns compared to the model, and that's because of several factors, not just because of differences in performance, subtle as it may be, but depending on the day that you actually place that trade, if you're using ETFs, intraday variations can vary, slippage can vary, and trading costs can vary. I'm just using this graph to show you that these two types of mutual funds, the S&P 500 index versus a total U.S. stock market index, are close enough that they can be interchangeable. So if we compare the S&P 500 index to a total U.S. stock market index, annualized growth is almost exactly the same. I mean, if you started out with $10,000 back in 1992, you'd be up only $232 using the total stock market index compared to S&P 500 index. I mean, okay, $200 is a lot. You're waiting 26 years to make that difference for a 0.23% difference. I'll let you figure out if this is a big enough difference to make a difference for you. So what about bonds? When stocks are in the safe zone, we're in that stock fund. But if it's dangerous to be in stocks, then what do we do with the money? We can either keep it in cash or we can keep it in a bond fund, but not all bond funds are made the same. So in my example in my book, I've usually used the long-term treasury bond fund from Vanguard as an example of what to do. Usually, bonds issued by the U.S. government are viewed as safer than any other bond issued by municipalities or corporations in America. That's one reason why I suggested long-term treasury bonds. Another one is usually the long-term treasury bonds yield higher returns. However, long-term bonds are usually more risky than short-term bonds. And I've been getting feedback that not every plan has access to long-term treasury bond funds. However, most plans do have access to some kind of bond market index. So let's take a look at the U.S. bond market index. There are usually some variations here and there depending on whichever mutual fund company you look at. But let's compare the two. So the blue line is the total U.S. bond index. The red line is the long-term treasury index. You can see the red line is much more squiggly, and that implies more volatility. That means sometimes you can actually lose more money with the long-term treasury bond fund than you can with their total U.S. bond index, because their total U.S. bond index, if you take a look at all the bonds, from short-term bonds to long-term bonds, the average age to maturity of these bonds is somewhere around 5 to 8 years. Whereas with the long-term, they're typically much longer. Now, bond pricing is another subject that I'm not going to get into here, but at least trying to impress on you that there are differences in bond funds. This long-term treasury bond fund is not always available. Their U.S. bond index type funds are more typically available. So one major change I'm going to deviate from my book going forward here is to use the US Bond Index Fund. So let's compare two. The long-term Treasury Bond Fund grew faster, annualized growth of 7.3%. Some people are happy if their stocks grow this fast, whereas the bonds over the last 30 years grew only 5.8% annualized, which means just 1.5% difference means this huge difference of what you get after 30 years of growth. And this is just me using the Sector Surfer software to give you more metrics in terms of measuring the difference in risk between the long-term Treasury Bond Fund versus the aggregate bond fund. You can compare relative risks, Sharpe ratio, Sortino ratio, look at the curves on quarterly returns, percent chance of losing more than 15% any 1 year versus gains. Feel free to pause this video anytime if you're interested in this data, or get your own Sector Surfer account and play with the numbers. So conventional wisdom is we're supposed to diversify, right? We're supposed to be something like 60% stock, 40% bond. Well, if we use the total stock market index and the total bond market index, and we do a 60-40 split, we get this yellow line. So it doesn't grow as fast as stocks, but doesn't crash as fast as stocks either, because it's diversified. You're diversifying the risk, but you're also diversifying away the returns. And ideally, if you have a 60-40 split, we should be maintaining some kind of rebalancing scheme, because let's say stocks suddenly took off. That means now you're more than 60% stock and you need to sell some stock to make it back to 60-40, because if that same stock component crashes, if you're more in stocks than 60, then your crash is going to be higher as well. So you can either, if you believe in conventional wisdom, to buy one fund for 60 and one fund for 40%, or you can use the Vanguard Balanced Index Fund. Now there are so many different kinds of mutual funds out there, but this is such a popular scheme to be 60% stock, 40% bond, that Vanguard has a mutual fund that is 60% stock and 40% bonds. Now, in no way am I saying this is a recommendation. I'm using this for comparison only. If you take a look at the prospectus, its investment objective is with 60% of its assets being the US stock market and 40% of its assets in the bond index. So really, these three lines are just comparing total stock market, the Vanguard Balanced Index Fund, and the total bond market. Now, obviously, conventional wisdom, there are strengths and weaknesses. Strength is it kind of mitigates risk. Weakness is it also kind of mitigates returns. And if you've been following my book or videos, you know that if there are other ways to mitigate risk, then you don't have to diversify to mitigate risk further. If you know that it's safe to be in stocks, be in stocks. If you know it's dangerous to be in stocks, get out of stocks and be in bonds. So if you did that, you get this purple line with that 20-month moving average as a signal whether or not it's safe or dangerous to be in the stock market. And so yes, even when correcting for fees, and that's why the purple line is underperforming the blue line here, you're still ahead, just rotating once every 3 years or so, whether or not the stocks are relatively safe or dangerous. Of course, you know that I'm going to be talking about Sector Surfer because Sector Surfer has its own safety belt called StormGuard Armor. And if you use StormGuard Armor, it trades maybe 1.5 times per year, so it's a little bit more frequently, and the returns are just more impressive. Now remember, for the data I'm presenting in this video, the returns are based on historical data. It's back-tested. And yes, future returns are not guaranteed based on past performance, and if strategies don't even pass past performance, there's no reason to suggest that that particular strategy would work in the future. So if you take a look at these three strategies using StormGuard Armor, using 20-month moving average, 60-40 stock bond split, you'll see to get any kind of meaningful comparison, you're going to have to go to a log scale. So if you do a log scale, so from this tick to this tick is 10 times, from this tick to this tick is 10 times. Basically, with a log scale, it's easier to see relative percent changes. Because with a regular linear scale, if you have a large number and changes a little, it looks like a big dip. But if you use a log scale, tiny dips are relatively comparable no matter where you are on the graph. So you can see that just visually, the 60-40 split is more volatile, therefore more risky, than are the two strategies. And here's how StormGuard Armor works. It's a filter, it's a safety belt, and see when the safety belts kick in, if the red is in the total stock market fund, the white is when we're in the bond funds, and that happens to be when we have these big corrections. Sometimes we're in for just a couple of months. Lately we've been in for the last couple of months here, end of 2018. And in fact, let's zoom in on just this past month. If you take a look at the last 3 months, we were in stocks because stocks were going up, but it has been going down. And finally, from beginning of November, it met criteria to get out of stocks and into bonds. So we went to bonds, and bonds went this way, whereas stocks kept on going down. So depending on how much longer this bear market lasts, could be months, could be years, could be just next month, at least we're relatively safe during this down market. And no, we didn't save ourselves from this drop in October, but we're getting out early enough that if we do have a huge bear market coming up, we're now relatively safe. So this is the StormGuard indicator showing that we are still clearly in negative territory. And just for number geeks out there, again, this isn't something that you have to study. If you really like numbers, go ahead and stop the video here and you can take a look at all these columns. So we're comparing the stock market index itself. So in other words, anytime you go to a financial advisor or trader and ask, why invest with you when all I need to do is invest in the stock market mutual fund? If they don't give you data like this, it's hard to compare. But here, stock market itself, diversified 60-40 stock bond, switching between stocks and bonds using 20-month moving average, and switching between stocks and bonds using StormGuard Armor. Now, remember, these two columns are actively traded. So that means you can either do this yourself, or if you want someone else to do it, I'm correcting for a possible 1% fee that manager might charge you for doing this for you. So even with the fees, you can see how the markets in general, they lost money in 1994. Here's a crash of 2000. Here's a crash of 2008. And here's 2018. With 20-month moving average, we pretty much protect against this big bear market. We kind of mitigated the 2008 bear market. But sometimes with whipsaws, like for instance in 2009, we actually underperformed the stock market. I mean, you can't win them all. But the number of losing years is the same, and the degree of loss is overall decreased. Now with StormGuard Armor, even with that 1% fee, over the last 24 years, not a single losing year so far. Again, no system is perfect. I'm not guaranteeing that you never lose. In fact, I'm not even guaranteeing that some years you may underperform the markets. Like for instance, here in 2016, it underperformed the stock market, and here in 2004, and here in 2003, and 1999. But this is the power of the safety belt. Our goal is just to try to mitigate the larger losses and let the winners take care of themselves. So the next system is the momentum rotation systems. Now, why am I changing the name of this? Wasn't this used to be MRI? Well, yes, we did have the monthly rotation investment system, abbreviated MRI system. Last year, I stopped covering just because the sector server version of the MRI system was just that much better. Just to remind you of the sector server version of the MRI, we use the same three mutual funds, the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. And all we're doing is figure out which one has the best momentum at any one time, and we just buy that one fund. Because it has an inverse fund already, there's already a built-in bear market safety guard. That's why we didn't use Storm Guard. However, after just going over several permutations of this and backtesting this and looking at how the results were this year, I'm finally giving a towel and saying the MRI system, it was my baby, I wrote about it in my book, but it is just a momentum strategy. It doesn't have the double guard of momentum plus a seatbelt. So if you use Sector Surfer with Storm Guard, you can beat MRI fairly consistently depending on how you structure it. So here's the MRI system using Sector Surfer. These three mutual funds, rotating, you can get this yellow line. I mean, not too shabby, you're beating the markets. You're making money even when the markets are going down. This year we did suffer another loss. I mean, some years we do lose. But the risk profiles, you take a look at any of these metrics here, the Sharpe ratio, Sortino ratio, the quarterly returns, the risk versus reward graphs, drawdowns versus returns. By any of these measures, I can do much better using Sector Surfer with Storm Guard than I can with the MRI system. So I'm just going to stop covering MRI. For my own clients, I'm just getting out of MRI, and we're just using straight Sector Surfer with Storm Guard. So how am I going to at least show you in the future videos how momentum rotation systems work? Well, here we have 7 different funds, 6 stock, 1 bond. And if all we did was every month figure out which of these funds has the best momentum and then just buy that one fund, we will get this yellow line. So yes, this yellow line beats the market. Yes, the yellow line doesn't lose much during the big bear markets. It is flat here when the markets were going up. There are ways to improve on this, and that's because, again, it's the same weakness as the MRI. We're relying on some other non-stock fund, such as a bond fund in this case, to be our savior when the stock markets go crazy. And we're only making 11% annualized compared to stock market 10%. But if we use Storm Guard Armor to go into the non-stock fund and use momentum rotation to rotate among these 6 stock funds when it's safe to be in stocks, we'd get this strategy, where the yellow line is now much smoother, much straighter, much more consistent, giving you closer to 18% per year annualized, with much less risk. Again, no system is perfect. Notice the line is wiggling. There are chances that you could lose money. And again, future performance is not guaranteed given the past results. But this is the power of using both Sector Surfer momentum rotation with the Storm Guard Armor. So we'll be monitoring this in the future as well. So our next system is the free Sector Surfer strategy that usually comes when you sign up for Sector Surfer. You get a free account with a free strategy. The reason why I say used to here is because the free strategy that came with mine, it used generic asset class funds, it used an older version of Storm Guard, it did not separate out stock from non-stock funds for rotation purposes, and it in general didn't do well. And one of the funds that it tracks, the S&P 500 Index Fund Fidelity, is no longer listed. So now, going forward, the data is going to be corrupt. And when I look up Sector Surfer, I see that this particular free strategy is no longer available to anyone who wants to pick one. So I'm using this opportunity to show you how to pick a free strategy. So let's say you sign up for Sector Surfer. Here's a Sector Surfer website, at least bits and pieces of it, and you want to import a free strategy. Well, if you go to the active strategies and you go to one of these empty slots, you have an S. The S button is to import a strategy. You click on the S button and it gives you the select a strategy dialog box. You unclick everything except the include free strategies it'll list all these free strategies, and you can be sure they're free because it says cost free. Once you see these free strategies, again, they're not great. Many of these are specific to particular broker-dealers. For instance, Dreyfus sells their own mutual funds, so here's one strategy that uses Dreyfus. Franklin Templeton uses their own mutual funds, Janus, etc., etc. So what if we use this generic ETF asset class? So if you look at this, you can look at all your returns, etc., scores, safety, etc., and you can always click on the chart button to take a look at this chart. And you see how it works. You have all these different ETFs, how it's using a older version of StormGuard. It's going to cash when it's dangerous to be in stocks in general. And it's producing around 15% per year. So if this is good enough for you, then it's free. But if you change any one thing here, then it's a paid subscription. But let's say you like this and you want to use it. So go ahead and click and say use selected. Click on use selected here on the bottom right hand corner. Bang. And here it is. It's now in your strategies. And not only that, but it says, hey, right now you're supposed to be in cash. Because right now this system has detected that it's dangerous to be in stock market. And it has this big red acknowledge trade button. So let's say you make this trade, or there's no trade here because you're in cash. You have an account ready to use the system, and you're in cash. Well, now you just click on acknowledge trade, and now it turns into a green done button with the date you did it. And Secretary of Surf will stop bothering you until the next signal comes along. And when that signal comes, it'll tell you what to sell and what to buy. And one more thing is, you might want to change your name here instead of My ETF Asset Class. Or not, you can keep it. But you can go to the I, which is the info button. You click on it, and now you can change the name, change some parameters, write some notes. If you want to give this particular code to a friend, you can just copy, paste, and email to someone else. Go crazy. And then you can just cancel or save. So the next system is the stock tip strategy. Now, I used to call this the 25% trailing stop loss strategy, but, one, it's a mouthful, and number two, the more technical it is, the less people tend to follow it. But yeah, stock tip strategy, this is only if you absolutely positively have to buy a particular stock for some strange reason. In general, it's not a good idea to be in love with any stock. Individual stocks have their own idiosyncratic risks. In other words, if you have stock-specific news about some kind of scandal or oil spill or something, the next day it could tank down and you can lose a lot of money. So that's why I don't recommend using stocks. But if you want to use stocks anyway, here's one method you can use. So the stock tip strategy rules. If you really, really want to buy a stock, limit your risk to only 1%, not 10, not 50, 1% of your portfolio or trading account. So if you have a 25% trailing stop loss order, that means you can buy with up to 4% of your trading account that one stock. This way, if it drops 25%, you've only lost 1% of your portfolio. Makes sense? And if the stock goes up 33%, you can go ahead and buy another block of stocks using another 4% of your account. And then, of course, update your trailing stop loss order to reflect the increased number of shares. And wash and repeat and wash, rinse, and repeat until you finally stopped out. Now, I don't use this that often, but I still do have a couple accounts that use the stock tip strategy, and I have been getting a lot of stop outs. So be very careful out there. If you're using this, make sure you didn't miss any stop loss signals, because there's no sense in having a stop loss in place when you don't respect it or use it. Alright, so in summary, we've revamped the format of these videos. This is a year-end summary where I revamped names for more clarity so more people can follow along and not get too confused. I reviewed our systems, including safety belt systems. I've at least gone over some momentum rotating systems so we know how the momentum rotation and safety belts can work together. we changed to a new free sector server strategy to follow along, and we are continuing to remind you of the stock tip strategy because several of you out there do use it. And just to remind you, these past 2 months we've been getting a lot of stop outs, trade alerts. So keep those questions coming. I know I talk to several of you personally each month, and I realize that for some of you these video updates are not enough, especially if you're still unhappy with the current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup session where it's just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup session, we'll together create a sense of clarity about the financial future you really want, the reasons you're investing to begin with and how to get you there, discuss investing building blocks that are more specific to your situation, determine what has stopped you in the past from getting what you want now, and identify what are the most important steps you need to take now to get your investment financial goals, and then complete a consultation with the excitement of knowing exactly what to do next to create that road to the future you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you have a financial cancer or blind spot you didn't know about, wouldn't you rather at least know now so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.